Yeah.
I wouldn't be surprised if the rebuild took us 10 years instead of 5. How do we position ourselves for one, the redistribution of wealth, and two, the creation of wealth, because they're separate. This is the fight of our generation, meaning that this is the moment that's going to define us. So it's a red pill, blue pill moment. NCB will have to shrink. They have to. They don't have a choice. Valuations have been the lowest they've been since about 2014 or before.
Yeah, they're pretty low. Hi guys, my name is Dr. Thaon Simms and welcome back to another episode of the Limitless podcast. Joining us as always is your co-host and festive co-host, that is Dr. Matthew Preston. Hail up the people them.
Hey guys, what's good?
He clearly had a lot
Merry
of sorrow
Christmas.
to drink. Big up to the returning guest himself, Mr. Julian Morrison, aka Dr. Doom, heading right back on the podcast. Welcome back, Julian. How you
One
been?
love, everybody. It's great. It's great to be back. It's great to be back on the infamous Limitless podcast, where you can have infamous guests.
That is it.
A
Both
place for
heroes
villains and heroes. Yeah, we'll say it at the same time.
Yo, you even have the villain laugh. I don't know if you hear that.
Yeah, you're funny,
bro, I
bro.
rate it.
That's crazy. Yeah.
But yeah, man, welcome back, Julian. It's been a minute, Julian's a very well-known guest on our channel, investment professional, big in the investment space. I remember Julian started, it was Wealth Watchers. I remember, I know you from Wealth Watchers days, and when I just
Respect,
started
brother.
to get into investing to now, where, you have this big love for economy, for like economics, music, a bunch of different loves. But mainly you're here for the investments, and you guys, the people that are here for the investment talk.
Yeah.
So Julian will be talking to us today. How's Christmas been, man?
Christmas has been good. I think we are getting a small break from a crazy year. A year that's like 3 or 4 years in one. I think everybody's tired.
Yeah.
Well, yeah, I feel upbeat. I have a great sense of clarity. And I'm looking forward to what's to come. I feel excited. How about you guys?
Well, let's hear from Preston, because I've spoken a lot. Preston, how you been?
I'd say it's been a
Well, we can see
interesting
how
year.
he's been.
Real.
Looks
Looks like
been
a
an interesting
prosperous
year.
year. Oh, okay.
Some wins, some losses, yes. But I think at the end of the day, I'm still here, so I have to just give thanks. And yeah, just looking forward to next year and what's to come.
Okay.
Yeah.
Okay, I'm happy for that. Yeah, it's the same. It's been a roller coaster of a year, but I'm hoping that 2026 brings a more positive outlook just on life on a whole. It's I know that the channel is mainly about investments and so on, but so many other things go on in each and every one of our lives. So I'm just hoping that not just for me, but for everybody else, this year is gonna be a really good year. So praying for that.
Health and wealth.
Yeah.
Health.
Yeah,
and
never
wealth.
since. Yeah, never since. Never since.
Yeah, man. That's the channel, That's Limitless, health and wealth. I rate that.
And a place for heroes and villains.
And a place for heroes.
Gosh.
Yeah, man. So, Julian, you spoke about 2020. Well, we're talking kind of about 2026 now. It's a different trajectory, a kind of a different shift. Because we went through a lot in 2025, and of course, the past always can influence the future. History, always has some foothold on what the future may bring. Tell us something about 2026 that you are either worried about or looking forward to.
Oh, I have to pick one? All right. I am looking forward to the opportunities that will arise because of the transition that the world is going through in Jamaica. I think we are in a big transition period. So I am very optimistic about the opportunities that are to come. I think there is a shift in US foreign policy. So based on those developments, one, we're likely to see greater chance of armed conflict, either in pockets or in larger dispensations. So you can see greater tension between US and China, and US becoming more focused on onshore business and breaking up the traditional globalization framework that we've been used to. We've grown up in a world that is all about coming together in terms of trade. Who produces the stuff most efficiently gets the job no matter what. That's changing. It's now becoming more strategic, where politics and economics are becoming more deeply interwoven and the world is splitting. So I've seen literature around this phenomenon. It's called Cold War II, which means that the world itself is becoming more polarized. So that's going to
Mm.
be with us for a little while, even after Trump. It's not something that's easily reversible. And in Jamaica now, clearly we are rebuilding as a country, and that's a major, it's going to be a major wealth transfer. And the idea is, how do we have the proper approach to that transfer of wealth? Some amount of wealth will be created, but a lot of it will be redistributed. So the idea
Mm.
now is, how do we make smart decisions around the redistribution of wealth? So I can just get into the analysis. The first thing I'll mention. Wait, by the way, is it time for me to get into the analysis? Because it's your show. I don't
Of
really want to.
course. Nah,
Yeah, sure,
yeah,
sure.
man.
Yeah, man. All
Go
right,
jump
cool. So
in.
yeah, man. 'Cause I don't know if you have a script that you want to stick to or whatever. All right.
No,
So
we do this on the fly all the time, actually. So
oh
yeah, there's no script.
yeah. You have to love the chaos. So
Yeah.
OJ mentioned that we have a rebuild timeline of 4 to 5 years, conservatively. His
Okay.
baseline was the recovery period coming out of the pandemic. He was saying it's going to take twice as long because of not just the loss of life, but the loss of assets and the things that support assets. So it's a big infrastructure rebuild. Now, if we
Mm-hmm.
use 5 years as a baseline period, I think Dr. Henry was being conservative, because if you have a planning authority, you have to have a balancing act between stating facts and also engendering a certain amount of optimism around the business community, both locally and internationally. Jamaica can't be posited as a lost case. So
Yeah.
I wouldn't be surprised if the rebuild took us 10 years instead of 5. That's the point of me. First thing. Second thing is, we already know tourism took a big hit. Agriculture took a big hit. Those may recover more quickly than other areas. For example, the path of rebuilding in terms of construction is likely to take a lot longer than a rebound in tourism might take, or rebound in agriculture might take. However, what's special about this is not just the rebuild itself, but what we call lag effects in economics. So what happened in agriculture will have lag effects that will last more than one financial year. So just because Jay mentioned that inflation is likely to average 8% next year, it doesn't mean that 2027 is going to just automatically revert completely to the target range. And even if it
Mm-hmm.
does, it means that the base prices are going to be that much higher. So what it means is that, okay, let's say it averages 6.5, which is just above the average, just above the target range. Averaging 6.5 of a large base amount or higher base prices is still significant. So we need to think about not just persons who earn from assets, but persons who earn from fixed salaries, middle class persons, working
Yeah.
class persons, people who live day to day are trying to make their ends meet. Why is this important? It means that a lot of our investments are going to be affected by how those people live, because we have to invest around these things.
True.
So, for example, an observation is that Kingston is likely to see a lot of crowding because
And
of
we know we
the,
needed more of that.
I mean, it is what it is already. I've noticed a change in the traffic since the storm in the Kingston
Mm-hmm.
metropolitan area. It's gotten much worse because, again, it's rural to urban migration. It has happened before in Jamaica, where a loss of infrastructure, a loss of jobs will cause persons to move, to make a living.
Yeah.
And even in the following 3 to 4 years, when some of those persons have more options and have a chance to go back home, many of them would have settled in Kingston and not moved back. So what you find is that there's going to be
Mm-hmm.
some amount of settlement in Kingston.
Yeah, it's difficult to move back when you come to the land of opportunity, I would say,
Yeah,
or you're
exactly.
in Kingston now where you can get jobs. I wouldn't say it's easy to get jobs, but you just have more opportunities because it's such a there are way more businesses, it just makes more sense. And there is going to be now that friction to move back, because why would you do that when you've already built your roots here, and you start you get in, you have your salary, maybe you have a kid or two, and they probably change schools and so on, so it's a lot more difficult to go back to the that rural migration. So I don't know if that's a government thing where they have to really be planning out how to get people moving back to those areas, or to just that rebuilding phase. I'm not sure how it can be done, because that's difficult. That's very difficult.
Yeah, I mean, it has a lot to do with planning, urban planning, city planning. I've
Hmm.
heard the government mention that they want to modernize Black River and how Black River is set up. A lot of the corridors are narrow. Same for Santa
True.
Cruz. A lot of the road corridors are narrow. They want to restructure the town so that it can be more modernized in terms of how traffic flows. And once you restructure roadways, the infrastructure around the roads tend to go in the same direction. So it's not
Yeah.
always just about having a road that's brand new, that works and it looks pretty and it can take more traffic. But based on how roads are set up, businesses will also set up their establishments around that, and that inadvertently affects the economy of the area.
Yeah.
But your point is so real to the point where we are living that story now. My parents are not from Kingston. My dad is from Clarendon. My mom is from Portland. My mom came to Kingston for high school and she never went back. And my dad came to Kingston for work. Actually, he came to Kingston for high school too. He did high school in Kingston as well. So they just didn't go back. It's not that they totally forgot about those areas. They still go from time to time, but that has changed their lives and they settled down. So this storm has driven so much more volume in terms of people to one area. One, that will squeeze the infrastructure, but two, that's a lot of
And
opportunity
prices.
for businesses. Yes, definitely. Kingston has always had higher consumer prices than rural areas.
Price smart banking.
Yeah, for sure. And there are a lot of businesses that are only in Kingston that are going to benefit significantly because of the higher density. So there's a crowd in there. And also, we need to look more at the sectors that are going to be affected by the rebuilding. Who is in the middle, who is on the winning side, and who will be at a disadvantage. So, for example, some businesses in food and beverage will come under strain because they're going to have to pay higher prices for raw material, but they may not be able to pass on all of those costs at once. So what we're seeing is almost like a repeat of 2023. The margins get squeezed.
Yeah.
And the flip side is the larger players who are able to bulk buy and control their supply chain and have more market share, they will likely fare better, like the Wisyncos of the world. And Wisynco has taken it a step further by expanding their product portfolio and offering products that they didn't have before, while still sticking to their core competence. Yeah.
I think they launched like some
beers and
have
the
you tried it
malts.
yet?
The malts.
I
I haven't had the malts as
thing.
yet, but I hear really good reviews.
Yeah.
You know, I've seen some of the, I know this on away, but that's just a terminology. I've seen the bodies online give the rave reviews and post it and everything, and they weren't paid
But
ads.
that's of the malt or the beer or both?
Both, actually.
Both. Okay.
Both. But I think I'm going to try it today.
Agreed. I've seen them post too. I have a few friends that have been posting. I don't know if it's that they've sponsored stuff. I think there was an event that happened recently too, because it's Christmas time, and I saw a lot of the legend beers being posted and so on. So I don't know if they're
but they've stuck to their core competence because they already have the fleet, already have the supply chain, the distribution outlet, so they can just plug it into the business. So it won't be a big strain for them in terms of capex. They just need it to do
I'm
the
happy
R&D.
that they just had, when you looked at just the amount of cash that they had on hand, it was like billions and billions of dollars, Like they weren't paying up the crazy dividend. I guess it's just hard for them. It's hard for something that their size to allocate that kind of money.
Well, it's relative, It's relative, Preston, because another side of the coin or another part of the argument is that the last time I checked, their export earnings in terms of revenue, or the revenue attributable to exports, was less than 5%, and they're doing double-digit billions in terms of revenue. So they had two options. They could either go deeper in the same market by having a wider range of products to choose from. So in other words, they would dominate a greater portion of your igloo from a product standpoint and earn more wallet share. So we'll call that wallet share, because you have market share and you have wallet share. When you have the same consumer spending more across more products, that's called wallet share. Market share is when you have more new customers buying the same thing. So they're taking a wallet share strategy, and they could do that, or they could do market share, but just in new markets, it should be overseas, because Jamaica middle class is not growing. The overall wallet share of the country, yes, we're getting more GDP per capita, but the truth of the matter is sometimes that can be tricky, because GDP per capita is your output divided by your population, right? But Jamaica's population is not growing that much. So let's say the
Yeah.
population it grows by 1% and GDP grows by 1.5. It's going to bias it upward. And a lot of that weakness in growth has to do with net migration. So when you have your highest earners in terms of competence and skills leaving,
Mm-hmm.
and you just have so many more left back, and it just so happens that you didn't have a bad year in terms of recovery, it might seem as though we're earning more per capita, but in real terms, it's not really the case. It's just
Yeah.
that there are so many more persons leaving than the country can actually grow. So it's just a statistical nuance. It's not that Jamaica is making that much more. And you can tell by the type of products that are being offered by the companies
Mm-hmm.
that are listed.
That's true.
Mm-hmm.
That's also very true. And then we know, I mean, as doctors, we know a lot of people migrating. They're always we have a very close connection with all doctors, especially the newer ones that just coming out of med school and so on. Every year we speak to them and we do sessions with them and so on. And the question is always asked about migration and doing US exams and so on. And I think now that's what most people look on, even when they're just getting into med school. Because I have a lot of friends now in um first year med, right? That I used to mentor and so on. I know they're in first year med, and none of them want to stay in Jamaica. And I'm just like, guys, your home country, But I get it. I get the push to migrate. I understand it. Being a doctor here is rough, and that's just medicine. I can't imagine all the other fields. All my friends that were in tech in my year group at Campion, then none of them really stay here in Jamaica anymore. So it is rough. Yeah.
Yeah.
So like,
But even earlier in the episode, we were mentioning a change in foreign policy. So it's actually going
mm,
to be harder to integrate into the US economy than in the past.
mm,
We will still see migration. I think that's
mm,
structural. That's something that will continue. But I think the type of migration and the volume is going to change in like the next 5 years because the US has. So let's backtrack. So the US has developed its country based on a certain approach to immigration. So they had more land than people for many years, for like 200 years. What
mm,
happened is that the city centers have all gotten more saturated. And not only that, beyond the saturation, you're now starting to have generations and generations and generations of Americans. So you don't have all these immigrants, so to speak. You have the descendants of immigrants who grew up in America because many of them have parents and grandparents who were immigrants. You can even use a Jamaican example.
yeah.
So what you find is that as you have more indigenous Americans in the context of being born there and
Mm-hmm.
the greater removal from looking to a home country, you're starting to see a shift in national identity and how persons hold on to their Americanness and what the American way of life will look like and certain ideas being promulgated and so on. So what it means is immigrants coming over to the US to make a life would have a different meaning in the 21st century than it would have before because of these dynamics. I wouldn't say the average American is more educated than in the past. I wouldn't say that. I would just say there's a change in terms of
Mm-hmm.
what America is prioritizing. So
Mm-hmm.
America now is fighting an economic war. They weren't doing that before. They financed a war that took place in the 20th century, and the country grew significantly from that financing. But that has
Yeah.
changed, and now America is back on the front line, but now they're fighting an economic war through policy and trade. And
Mm-hmm.
because of that, they need the people to fight that battle. So instead of having soldiers, they need a labor force. And they don't
Yeah.
necessarily want to take foreigners to be a part of that labor force for obvious reasons. They're fighting an economic war. So they're going
Mm-hmm.
they're going to become a bit more xenophobic, or what is considered to be xenophobic. So again, the migration story is going to change. That's going to change our trajectory. That's going to change our options that we have. Even us as investors, we may look at an opportunity and say, okay, I want to buy 3 condos in Miami 5 years from now. The US might say, look, we are reserving X amount of condos for Americans. And if Americans don't buy them, then we'll consider you after. That's a very real eventuality now. So you will see nationalism pop up in areas that didn't have that kind of feature before. So back to Jamaica now. I think that for clear reasons, Lumber Depot, Carib Cement should do extremely well. I'm told that some of the hardware stores, they just don't have enough inventory to catch up with the demand as it relates to cement. Other things like wood, lumber, they just can't
Mm-hmm.
keep up with the volume. And I think
Mm-hmm.
that's likely to continue for a while. So
And
I
you
think those are
even look
areas you
at
could look at.
think about if Carb Cement hadn't done their upgrade. Think about that. That's in that case with the 30% upgrade they finished, I think, earlier this year. I even think that the government may have to end up allowing more importers. So like, for
Yeah, they
example,
have to.
cargo handlers. I think cargo handlers is another one that people aren't really realizing. Wait, they own a cement company. They're probably going to get an increase in their quota. Okay, we even look at, I think ground zero was Westmoreland, but Mobay got hit really hard.
Yeah,
And cargo
because
handlers
it's
deals
just
with that
right beside
port.
it. Yeah.
So it all of those developments and stuff and the road work and things like that that will need cement and stuff like that. I think they're probably gonna, or I think it would be, they will at least lobby it for an increase in the quota. And so there's a chance that they could end up winning something like that. Like, hey, I see the amount of quota, like, oh, we can do 20% more, 50% more. Or I was even thinking that, hey, this could be an opportunity for a lot of hardware companies. I think about it right now. You mentioned Lumber Atlantic, they're listed. I'm sure there are other hardware companies that could list if they were. This would be a good time. I think, like in some ways, it's a bad time because you'd say, "Oh, what happened with the economy?" But there's another side where it's a bull case where you can say, "Hey, we're going to likely experience significant growth for the next." You mentioned how many years? 5, 10 years plus.
Yeah.
Give us some money, sell a piece of the business, and let's grow the business together.
Yeah, net on a net basis, I think it's a bull case. The only challenge, I'll get to the challenge after. Let me just finish the point. It's a bull case because I am of the view that Jamaica needed a catalyst. Jamaica needed a reset. We needed a reason to retest our thesis about what we're capable of as a country. We needed a sense of nationhood because and this is just my opinion, it's not economic, whatever. But I just think that we were losing our way a bit in terms of just going through the motion. Okay, we're a tourist destination, but what does it mean to be Jamaican? I think the storm has forced us to take a different approach. And now we have a chance to replace what was there before with something new. It may or may not be better, but we have a chance now to draw fresh lines. Again, it's inevitable. It's something that's in motion. So the question always is, how do we position ourselves for one, redistribution of wealth, and two, the creation of wealth, because they're separate. So what do I mean by wealth redistribution? Some persons, unfortunately, will have to sell their land just to make a new life. They may be able to get land somewhere else cheaper, but persons may have titles, but they've lost so much income and they've lost so much of their assets and they don't have insurance. And how they make money is by having all of those things in place. They may have to sell their land to start over. So who is the purchaser? And what about persons who are on the other end of the trade doing land banking? What does that mean for real estate? So I feel as though in another 10 years, we're going to see a very different Santa Cruz and a very different Black River, for example, and a different Westmoreland to a lesser extent, and even Mobay. Mobay is going to see a major shift. So again, there's an opportunity in it. What I'm concerned about though is the middle class persons earning fixed incomes. When this inflation wave passes, prices are not going to go back to pre-Melissa levels or pre-COVID levels. So how do those persons manage? And that's why platforms like Limitless, Wealth Watch, they are so important because we can't live the life that we lived before. We have to be very dynamic. We're going towards Cold War II. We're going towards a rebuilding. The next 10 years are going to be much different than the last 10 years. How do we position? And you know, I'm a healthcare bull already, declaring bias. I'm an investment professional at NovaMed. So clearly, investing in healthcare is a huge opportunity. There's R.A. Williams, there's Indus Pharma, there's Elite Diagnostics, there's GUS. And what's interesting about this time is that we have to look at company performance differently because earnings are going to be soft for at least another 2 to 3 years. We're not going to see these big jumps in earning necessarily, not organically because of the rebuilding. A lot of this is going to show up on the P&L, but now is a time for capital. How are companies allocating capital? You just said it a while ago, Preston. Increasing capacity. Cargo handlers increasing capacity. Carb Cement increasing capacity. Fontana just did some M&A. Now they're perfectly positioned to take more volume because there are more persons in Kingston to begin with. So it's a different Fontana now. We're dealing with Fontana 2.0. Well, 3.0
Yeah.
because the Waterloo
Portmore
location. Yeah. But
and Waterloo, yeah.
Waterloo was already Fontana 2.0 because that's why they listed. But now with Portmore and Monarch integrated into everything else is Fontana 3.0. So again, that's really the thought process. I'm
Yeah,
also
I'm looking
bullish
at a
on.
lot of companies doing things like that too. Because even look at like Mailpack. and Mailpack buying My Cart Express, and now they're the whole My Pack group or so on,
My cart
and My Cart,
or
yeah.
meal cart. I remember.
No,
I think it's my
I think
pack.
it's
I think
My
it's my
Pack.
pack.
It's my
I think
pack.
it's My
Or they're
Pack
Okay.
gonna
group, yeah.
rename or something.
Mm-hmm.
Yeah, yeah,
Yeah, and I'm just
yeah.
seeing a lot of that kind of is now. Like I think a lot more companies are gonna start to take advantage of. I'm thinking that the GKs, right? And what was GK gonna acquire next? That's something Preston and I were discussing on a previous podcast episode. So I don't even know if that's released yet. Yeah,
You mean the tasty deal?
no,
But I think that's one
but
of the more
that
recent ones. But I think we're just saying the bigger. We're just saying that that's a sign of the things to come.
Yeah.
yeah.
I'm there with you 100% because remember, M&A is due to capital.
Mm,
M&A is rarely P&L driven. M&A is capital driven. So I can share some more ideas around this. For example, like financial industry, for the most part, did not prepare for the post-COVID inflation phase, and many of them got squeezed as a result. They thought interest rates were going to fall faster than they did. So what happened is many of those entities had to swallow more impairments than they provisioned for initially. And as a result, even though it came out okay in terms of P&L, in terms of capital, they didn't. So a lot of these firms were fragile. Secondly, not only did they have to swallow more impairments in terms of securities loans, a lot of loans did not recover in the way that they had modeled. So after they've done these loan restructuring exercises, they had to let go staff, they had to do a lot more things that were messier that they didn't
mm-hmm.
anticipate. So they're on the back of their heels. Now, what most of the growth we've seen since the pandemic, interestingly, is recovery growth. It's not as though the economy itself is becoming larger, it's catch up. Because from the data we've worked through, Jamaica did not get back to its Q4 2019 size in terms of output, dealing with size now. Because the growth is just a percentage change. Actual size of the economy is different. We didn't get back to our Q4 2019 size until about the middle of this year. Because remember,
Yeah.
we had a recession in 2024. They tried to downplay it. They say it's not a recession because of employment and yada, yada, yada. Truth of the matter is, 2 consecutive quarters or more of decline is a recession or had a recession in 24. And 24 should have been a continuation of the catch up. So
Mm-hmm.
in 24, we had a recession, which set us back. Then we just got back to the Q4 2019 output in the summer of this year. And then lo and behold, we hit by the strongest system to make landfall in the Western Hemisphere. It's crazy.
Yeah.
But again,
It's insane.
yeah. So again, it's also a generational thing. I think this is the fight of our generation, meaning that this is the moment that's going to define us. So it's a red pill, blue pill moment. And I think even though there's going to be a lot of hurt, there's going to be a lot of hurt. I think the middle class is going to struggle. They're going to be stretched. But it doesn't mean that there aren't opportunities because some things are inevitable. Look at Kingston Wharves and how Kingston Wharves acquired a stake in cargo handlers. That was telling. Because Kingston Wharves is the southern coast. They didn't have any exposure to the ports on the north, and they just acquired the stake instead.
They hinted at it, you know. They
Yeah.
hinted at it from before.
Yeah, man. And you
Yeah, we
mentioned
actually
GK.
said it last year, I believe, Preston, on the podcast when we were breaking down Kingston Wharves. I think we did a tickers on them in 2024.
Yeah.
Just some
And
good old
Preston
speculation.
it was speculation, but you literally said it though that they could
Yeah,
acquire
I
a
did the
piece of
math on it. I was like, yeah, it makes sense. They could have said, I want to go west. Who is in the west? Why build up a port in the west instead of just buying someone else in the west, you know?
Yeah,
Yeah.
and that's their model too. Their model has been acquisitive. That's a big part of it because it's better to scale that way. Everything is in place. And not only that, Wharves has been doing that for a while. So it's in line with their ethos. It's not as though they only did business one way and then now they're doing acquisitions. They're very versed on it. And again, they are piloted or co-piloted by Pan Jamaica Group because they're affiliated with them. So Pan Jamaica Group by structure is an investment holding company. So they're also acquisitive. So that's the DNA within which Kingston Wharves is working. So I think it's a very exciting time.
You haven't even said the buzzword of 2024 and 2025.
What's that?
AI.
Oh,
AI?
You haven't even mentioned anything about AI or anything like that.
Well, let me tell you, my I have a bias, right?
Mm-hmm.
Mm.
I do believe that AI is transformative across the board, right? And I have to take a step back because where we are and where the US is worlds apart, right? So in terms of development, we are still developing. The US is in a post-industrial development phase. So a lot of what we're trying to get to, the US has already passed. So they have railway, they have urban planning. Yes, they're not perfect, but a lot of the things that we're struggling with, they have mastered it and moved on. They have
Mm-hmm.
infrastructure that they need to update. We have infrastructure that we need to build. We need a lot more expansion of our ports. As a matter of fact, I feel as though where we're going needs to be oriented towards industrializing because our industrialization started, but it got interrupted. Right after the 60s, we kind of peaked where we had a lot of our industrial output peaking. So you're talking about bauxite at record levels, bananas at record levels. We had the construction of large middle class communities like Mona and Delaney Park and Portmore. All of these things were happening at the same time. And then when the
Mm-hmm.
energy crisis hit, a lot of the capital from foreign pulled back. So you had a drying up of foreign direct investment because a lot of that industrialization was coming from outside in terms of capital. So I had external capital funding us, growing. And when the oil shock came, that was a big issue. There was hyperinflation. And then we made some policy mistakes that made it worse. So that extended all the way over into the 90s. So the point is, the growth that should have taken place in the 90s, and I don't mean in terms of percentage change like GDP growth. I mean in terms of growth, in terms of capacity. So the type of structures that we should have built in the 80s and 90s, we've been building it, but we need to do a lot more of that, not just because of the storm, but because we're behind from an industrialization standpoint. So I feel like we need to tick the boxes first before we try and do a tech revolution. Because tech revolutions normally need hardware to plug into, right? We
Yeah.
need that infrastructure to plug into. So in the US, their power grids are struggling because they don't have enough power to power the normal economy plus the tech revolution on top of it. Because their power demand is so much higher now, all at once. And they didn't know this
Mm.
was going to happen. Right now, what's
Yeah.
driving the US economy is capex. Not even consumer spending enough, firm spending on AI. That's insane. While out here, we're patching our potholes and we're taking our time. So it's not that I don't think there's an AI case. I'm not discounting AI, but we are
Mhm.
Yeah.
like years and years and years and years
Mhm.
behind. And I feel like we need to get certain things right before we start saying, look, all right,
Mhm.
cool. We need a tech revolution. Yes, we need tech.
Mhm.
Tech is going
Mhm.
to be a part of it. I mean, this call right now is a part of tech, but
Mm-hmm.
we need to get the basics right. We need to learn how to manage our projects properly. We can't be taking a year to fix a road that's a kilometer long. We're past that. It's not in the stone ages. It's poor
For
project
real.
management. That's what we
Mm-hmm.
need to get right. Once we do
Yeah.
that, the economy will take care of itself. That's what I
Mhm.
think.
You know, something I saw recently, earlier this year, I had
Yeah.
upgraded my desktop. So got a new processor, the board, RAM, hard drive. The RAM that I bought was $100, and I think this was in May. When I checked the price now, it is now 400 US. The same RAM stick. It's gone up 300%
Oh,
between May and now.
ouch.
Yeah, and that's because of like the whole AI boom and stuff. That single RAM stick has performed better than my entire portfolio. I should have been buying RAM.
Man, that's crazy.
Yeah, so yeah, it's a real thing. It's a real thing. The thing is, it's not. I don't even really see it necessarily slowing down for now because it's
Uh-uh.
not something that's easy to. You can't
No,
just
no,
quickly build a factory like that.
no,
And
no,
then the
no.
whole AI stuff, the infrastructure spending, it just keeps going up and up. So I'm like, yo, this thing could even go more. It's crazy.
Yeah, because to support the AI, you need the chips, and then in order to not just build the chips, but to run the entire operation, you need a certain amount of power and you need a certain amount of cooling. So
Mm-hmm.
there's great demand for water, there's great demand
Mm-hmm.
for power, and
Mm-hmm.
again, that goes back to industrialization and what we're talking about. The US is entering a new industrial phase. So they were already ahead of us. Let's say they were at phase three, they're about to enter phase four. We are still at phase two. So
Mm-hmm.
again, we are rebuilding our major cities. Downtown Kingston is still derelict. We haven't done anything with downtown. But downtown has an optimal layout because downtown has some of the roads going up, some of the roads going down. A lot of the administrative buildings are centralized and around a square. And downtown in some ways is a lot better planned than New Kingston. New Kingston is very chaotic and hodgepodge. And then, okay, there's a lack of parking. But if you were to put a certain amount of parking garages and stack them in downtown,
Yeah.
downtown will function better. It's just that a lot of these things are not in place, but downtown has not been utilized at all. There's no way we can seriously talk about economic growth without fixing our capital. That's unheard of. Everywhere you go in the
Yeah.
world, you hinge growth on your capital. Jamaica is the only country that tries to go around that. We're like, downtown, too much bad man and madman and dirty buildings, whatever. It's impossible. It's crazy.
That's true. The AI thing is real though. Like those RAM sticks, bro. I can't. That's why I'm saying now. Now I can't build a computer. I wanted to build a computer now, but it don't make sense. I'm just gonna chill for
Well,
the
you
next couple of years with this
I could
MacBook,
you could check I should check used prices,
eBay,
but I
and
guess
so on.
used. Yeah, or you could just buy from other people. For example, there's other Jamaicans or other people who have them. They might not really sell it as high as that price. They might not be checking the
No,
price online like that.
you're right. I mean, it's just it's not necessary though. Like right now,
Mm.
so I'm not like in
I
a
might just
rush
let you
to
know. You
get
may
it.
have to wait a while. You may
Yeah,
have to
that's
wait.
fine.
Could be a couple years.
That's fine. Hey,
Could be
instead
a
of buying
couple
a RAM
years.
stick, I could have used the money and just buy a MacBook Pro. Let's make sense. Might as well just buy a MacBook Pro. And I think the thing with even AI too is like even the chips that you're buying is still coming from one place. It's TSMC. So even the demand itself, you can't meet the demand with just one supplier or
Mhm.
one major supplier. You need multiple suppliers.
Yeah.
And then the US wants to be doing that. Now they're the ones that are spending on and they're at same kind of political war or so on with China, right? And they're trying to be very competitive with China, but it's hard to catch up to that level. Like you have to spend billions on just research and development, right? Just to see how have they gotten their chips that small. Like I don't know if you guys watch MKBHD. He did a cool Christmas-ish
Mm.
video on chips and just the size of the chips, and they're the size of bacteria. The transistors are smaller than the size of bacteria. Isn't that insane to you? Like to me, that's insane that the transistors have gotten that small. Because just maybe about half a century ago, the size of a transistor was like this big. Now it's shrunk to the size of you can have millions of transistors on one chip,
I
and
think
the
it's
chip is
billions. I think it's
billions
even
on one
billions
chip,
or something. Yeah.
right?
Maybe that is what has driven the bull run in metals because gold
Mm-hmm.
and silver are conductors of electricity and you need that
Mm-hmm.
to actually build chips. A lot of circuits use gold, real gold. So I think that's a big part of the gold and silver rally. In a previous life when I was at Proven, we actually did an article on investing in metals. At the time it
Mm-hmm.
seemed very esoteric, like, okay guys, you guys are just nerdy now, but the metals run has outperformed
Yeah.
most asset classes this year.
Mm-hmm.
It may or may not continue into next year. I suspect it will because I think it's underpinned by the need
Mm-hmm.
for conductors and materials that can conduct electricity.
Mm-hmm.
We didn't even talk about EVs and EV technology and
Lithium and batteries
alternate
and
energy.
solar
All those
and
things need gold and silver.
silver,
Mm-hmm.
lithium.
And
Yeah,
then
all
even in
those
healthcare,
metals.
a lot of medical equipment is made out of silver.
Mm-hmm.
Dental equipment made out of silver. Surgical equipment, and not just the machines, but we're talking about the instruments that they use to operate. A lot of those things are made out of fine metals because when you sterilize them, they have a greater effect than some other materials. There's wide use case application for these metals, and that's what has driven the bull case. They're not great for income unless you're just gonna trade the spread, but they can be a portfolio diversifier if you're looking for some cap gain from different areas. If you're sitting in assets that are richly overvalued, so for example, an investor who might have been in Nvidia for 2 or 3 years and might want to take
Mm-hmm.
some gains and go into some ETFs that hold silver or gold,
Mm-hmm.
or they do like a pairing where you take you take a dual exposure instead of leaning into one metal. You can buy like a metal basket or You do two sides of the same trade where you're taking a bullish bet on both sides, but you're doing it through two different instruments or two different sets of instruments. So you do two metals instead of one.
I'm literally looking at the charts. I don't know if you guys can see, but this is
Yeah.
like silver's chart. You know, it's mooned. It's skyrocketed in the past. This is from October. October it was like $46, and now it's, you
How
know,
far back
December
can you go
it's
back?
80.
Yeah.
Yeah, let's go. Let's do the 3-month chart
If you were
and
to
see
do if
Do
you were to
all
do
time.
if you were to do a
all time,
moving yeah if you were
Oh yeah, wow, all time high.
yeah if you were to do a
all
moving
time
average study, it would
Mm-hmm.
be
platinum.
overbought significantly.
Mm-hmm.
And you were to layer that over like a relative strength index, you'd say momentum that suggests that there's going to be a very strong correction soon, which may be the case.
Mm,
But I don't think the bull case for metals is over, because what we
Mm-hmm.
didn't speak about is the fact that that Cold War II, I should say, involves a different allocation of fiscal resources. So what you find is that if you're going to break away from the traditional model of
the dollar.
globalization, right?
Oh,
I get into the dollar. What it
mm-hmm,
means is that you're going to have to borrow a lot more to fund all of these capital projects that we're talking about, because the money has to come from somewhere. And it's not
Mm-hmm.
as though the US economy is growing by 10, 15, 12%. It's growing by 2 or 3% per year. So you have to borrow to fund all that
mm-hmm,
capex. What that means is that the US economy is going to become more leveraged. And as it becomes more leveraged, it puts more fiscal strain on how the country manages its budget, and as a result, the dollar will be held hostage. So what that means is that the US dollar is likely to lose its value faster against other
Mm-hmm.
currency pairs for the next couple of years. So inflation is likely to average high 2 or low 3 for the next couple of years from a US dollar standpoint. And as a result, investors will try to hedge in metals. So that's the whole point of us talking about the change in regime and why the US is going in a different area. It's not as though we're trying to be revisionist historians, but we're looking at the investment thesis from a top down, so we're not taken by surprise. We know how to invest. You have to
Mm-hmm.
invest around these things. And who articulated this first was Ray Dalio. Ray Dalio was like, cash is
Yo,
trash.
that's crazy. I was just thinking about you. I was gonna ask if you follow him because I
Yeah.
remember watching a video maybe 2 years ago from him. And I
Yeah.
think it was like an excerpt from one of his books, and he was talking about the changing world order.
Yeah,
And I
that's
was
the
like
name of it.
showing
I have it
about
in my collection.
like he was talking about how every global dominating country or global dominating power at some point ends up losing it. And he was like explaining basically a thesis around why it will always happen. So it's like the same things that make that country or currency go up in value and dominate eventually then make it that it's very hard to maintain, and then eventually it will fail. And he went through different ones about like French and in the UK, and he was showing a case for like that happening with the US. And he was almost like kind of suggesting that, hey, China may be able to be the next global or dominating power, or that was at least the takeaway that I got from it.
I've heard that from a lot of investment thought leaders, especially those that are established like Ray Dalio. They pretty much said, look, the next superpower is China. Like, just don't try and talk around it. Like, the reality is it's going to be China. And my view is that even if China does not surpass the US, China, for the rest of our lives, is going to continue to threaten the US. They don't need to surpass them. That's my point.
that's true.
So it's a matter of semantics.
And I think even with the trade wars and so on that have been going on with the US, you do see China taking an opportunity in like global partners that have been left out. So I see them now. I was watching a video on how they've grown their GDP significantly. I think this is the highest their GDP has been. And I was shocked because I'm like, how is that possible with, you know, the tariffs and so on? But they're exporting a lot to different countries now. It's not just their reliance on the US as their number one consumer. Like Chinese EVs are everywhere, not just Jamaica, but they're dominating even in the European market and so on. And that's just EVs on a whole. If the US pulling out of things like solar and, you know, renewable energy, who is the number one producer of solar panels? It is China. And anything within that renewable space, they just have a lot more opportunity now based on this, the geopolitical climate right now. And so I see them winning a lot right now.
Yeah,
Eh,
because China has built it's very similar to Germany in the 20th century. Germany built a society of engineers. France did too. Before that, France for a period they were heavily industrialized and they built a society of engineers. That's why France was so strong in mathematics. You had people like Laplace. So many mathematical discoveries were found by French mathematicians. It's because they built a society of engineers. China did the same thing. And believe it or not, the Chinese, they're students of history. Their society is over 3,000 years old, while the US is less
mm,
than 300. You're really playing with a monster. They're huge. They're very driven by STEM, even before it was called STEM. Very, very quantitatively driven. And again, their culture is not individualistic. In the West, we try to promulgate individual success. In China, they promulgate the success of groups. So how does my clan succeed? How does my household succeed? How does my nation
mhm.
succeed? They have a greater sense of nationhood. So America has realized that and they're like, they have nationhood and we don't. Like, we need to reverse this, which is why you're seeing more of a nationalistic posture in their trade policy, immigration policy, and economic policy. So everything is coming together. And again, we have to invest around this. So, in terms of interest rates, for example, I don't expect BOJ to be that accommodative. It's very hard for them to cut interest rates when they have an inflation target. Their own projection is such that we're going to see an overshoot for all of next year, pretty much, to the point where we're going to have an 8% average. So again, I expect trading volumes to remain soft, both on the June and main market index. And I also think I expect earnings to be soft because initially you're going to see the hit from all the expenses that the companies are going to have to absorb just as a means of doing business. Higher raw material costs, higher energy costs, having to find more effects to buy the same goods, etc., etc., etc. However, at some point, there's going to be a turning point. So we need to pick winners early. And we need to be open minded in looking at earnings. Just because a company posts a bad quarter, so to speak, in terms of P&L, it doesn't mean that the company is bad. It's an opportunity to look more at the balance sheet and to say, okay, what companies have the balance sheet that can survive a condition like this?
Yeah.
What company has a balance sheet that can do an acquisition? What company has a balance sheet that can keep paying dividends? What company has a balance sheet such that they can take market share from another company without going out of business and stretching themselves too far? Or they can just decide to go wallet share like Wisynco. Again, right now we need to be balance sheet oriented and not P&L oriented because P&L is going to show ugly results for the next 2 years very comfortably. And we need to be sector oriented and not just look at companies in a vacuum. So again, logistics is a good space. We spoke about that already. The cargo
Yeah,
handlers
really
of the
good space.
world, Kingston Wharves, Mailpack is logistics. And again, I expect a lot of M&A. I expect M&A to be big in financial services, as I mentioned before. A lot of those balance sheets were not prepared for COVID and they came into this vulnerable. They are not
Mm,
positioned for a national rebuild. So what's going to happen is even if a large entity doesn't get acquired by another large entity, we may see large entities shrinking. So for example, Jamaica National has shrunk. They sold
yeah.
their entire real estate portfolio of locations to Eppley and just to get some liquidity in. Eppley
Mm,
bought their
I think
entire branch network in terms of
they
real
sold
estate.
their general insurance arm to BCIC, right?
Yeah, they did because they needed liquidity.
Yeah.
So they had to shrink. And I would just say that don't be surprised if that continues to happen with JN. But it's not limited to JN. NCB has been selling subsidiaries too. For the current financial year, their largest gain came from the sale of a subsidiary. NCB will have to shrink. They have to. They don't have a choice. And again, that's why I keep talking about capital. PNL is not going to tell you this stuff. The PNL shows you what happens afterwards and the results of capital being used. But again, you need to look at how capital is positioned to say, okay, what options does this company have? Where are they likely to be in the future based on where their balance sheet is right now? So that's how I've always gauged my picks. Fontana, Scotia, Wisynco, these are companies with really strong balance sheets and companies with options. They can choose to acquire They can choose to launch new products. They can merge. They can absorb things that are split off from other companies. That's the area you need to be positioning.
I think
Yeah.
Wisynco, what was it Wisynco bought? They bought something
They buy
earlier this
stuff
year,
all
like
the time. I
Select
don't even
Brands or
remember off the
something like
top of
that.
my head. No, I don't think they own Select Brands. They have a partnership with Select Brands. They distribute part of their product portfolio. And they also have the, you know what, verify that. Because they might have acquired Select Brands and I'm just not remembering. Because I remember there
Yeah.
was
I don't think
a
so.
announcement
Try to
recently.
find the,
There was a Select Brands
oh, hold on.
announcement that came afterwards, you know. Let's check
I
it.
found a notice. Let me,
Oh yeah, I found that article too.
yeah.
It's a
So this is
strategic
this is,
alliance
yeah, there's a
with like
30%
Stones,
equity
Ginger.
stake in Ringtail Holdings, which is the parent company of Select Brands.
So they did acquire, yes, they did.
So,
They invested directly in Select Brands itself. Before they
Oh
used to
yeah,
just
see too.
distribute some of their products. So yes, yep.
Yeah, because I know Wisynco is pushing into like the spirits, like alcohol and
Wallet
liquor
share.
and
We're
beer
getting into
and
wallet share. It's greater wallet share. Because those are higher margin products than water,
definitely,
right?
definitely.
Yeah.
And they, as you
So
said, they already have the distribution network, so that
they
can be
have it to
pushed
plug
so
into and
easily.
they know that side of the business and these are complementary products. So you can sell them together. So when you're at a party, you're not just going to consume water alone, you're going to consume water. So people will consume beer, some people will consume a malt and use a malt as a chaser, etc., etc., etc. Yeah. It's all
it
about
makes them
having a
more
product
competitive
portfolio.
with the party, I guess. Because like if someone is selling, well, just their products, I guess, on a whole. Because like if you're gonna do a party and you were gonna do a rum, or say you wanted to do a beer, water, and then chaser like cran water, maybe
Or
instead
boom.
of buying some, if Legends beer was to actually take off, instead of buying them the red stripe, you'd say, okay, let me do Legends beer, water, and then cran water, which would be all of that Wisynco products.
But Wisynco already does that with the hotels. When you look in the hotel fridge, it's Wisynco
Yeah,
products alone,
it's really
or
just Wisynco
predominantly.
Core.
products.
So they have
A
those
lot
kind
of
of
them.
package deals already. So even beyond that, they already have
Yeah,
that in the tourism space big time. And again, they haven't even touched their scope in terms of exports. And there's a world out
exactly.
there that they can take.
That's a real big thing for them, is really exports.
Yeah.
Yeah,
Is really
When you see them
exports.
start growing exports, you know it's gonna be a different ball game. Because
different
I see
ball
them
game.
even experimenting with how they even package their products too. Because I'm seeing water in Tetra packs. I've never used to see that before.
Yeah.
You know, and I think the global market loves that. Like they're anti-plastic, which I rate that. But having water in Tetra Pak, seeing that being exported now, or other products are being exported like that, I think it would be, because even on the boom, I see them moving away from not just the plastic containers, but they have canned boom now. I don't know if you guys see that, and so on. So I see them experimenting with just how they package their products.
Yeah.
Imagine you buying like Stone's ginger wine because they own that percentage of Stone's ginger wine now, and so on. Like, and they're producing it. And yeah, greater wallet share, as you say, Julian. Curious to see what more they do because they have so many products now.
Yeah.
It really is. Can they get them on shelves in like Walmart or in England or so on?
Yeah.
So yeah,
Or even parts of Latin America. Because Latin America consumes a lot of rum, and sometimes if you can sell the chaser to go with the rum, then that's an opportunity. Because again, they are complementary products. But what I'll share too is I think that this market, just like in the last 2 years, is going to see a greater is going to see a greater emphasis from income generating investments. Dividends are going to continue to play a significant part in the portfolio. So the Trans Jamaican Highways of the world, the Eppley of the world, especially the Caribbean Property Fund, I think those are good opportunities to consider. I mentioned Fontana before, I mentioned Scotia. So we need to be balance sheet driven as investors and to also keep a certain amount of cash in the portfolio. Don't overinvest. Now is a good time to be opportunistic because things are going to pop up. A lot of change is happening. So it's good to maintain dry powder now. Dry powder is very important to have, which is why I also mentioned income investments because that can be a part of the dry powder strategy. So it's not like 2021 where you can just be like, oh, I can just book this gain and rinse and repeat. Not going to see so many instruments popping on the market and going to a rally, and you have that wide menu of things to trade off and rinse and go into new assets. It's going to be different. And you have to extend your time horizon because the bull market is going to come back. But again, you want to position your holdings in such a way that you have loss minimization key, right? Mathematically, it's hard to recover.
First rule, don't lose money.
Correct. And two,
second rule, don't lose money.
Yeah. And then two, now, you want to ensure that when the bull market does come back, you're well positioned because right now, valuations have been the lowest they've been since about 2014 or before.
Yeah, they're pretty low. You're looking at PEs that are so small.
It's going to drop even more because, again, the earnings going to be bad. So what you find is that people will sell down when they see that, and it's just going to cause valuations to drop. And even if it was funny, Thaon, sometimes because of what we're going through right now is so nuanced, sometimes we need to not look at the ratios or the KPIs in a vacuum. So sometimes you cannot say, boy, this PE is 30. I can't buy that because, my framework is this. Why is it PE 30? You're having a terrible quarter or you're having a terrible financial year because of what's going on economically. It doesn't mean that the company doesn't have earning power. The company is just transitioning because of something macro. So sometimes we need to take a step back and say, okay, what are these KPIs really saying? What's really going on in the country itself? Jamaica is going through something unique. So sometimes we need to take a balanced approach where like, okay, we're being disciplined, but at the same time, it's not a business as usual thing. So sometimes we need to drop PE and just be like, yo, okay, where has PE been in the last 5 years? And why the PE skyrocket? Oh, it's because they had to expense all their gains from this acquisition, like in the case of Fontana.
Yeah.
Not that they're PE is 30, but again, you have one-off situations, is what I'm saying.
I was looking at a lot of the financial even institutions now. I'm looking at Scotia. Scotia is at $55 and their P is 8.6. Even a company like Dollar.
Scotia is a machine.
Scotia is a machine. Dollar's PE is 12 and that's at $2.45. JMMB is at 5. The PE is like 5.6. NCB's PE is 4.45. At $40. So it's I still think there are a lot of financial institutions and barring the other things that are going on with like NCB and these other companies, but like a lot of opportunities there, man. A lot of opportunities. Because people are always like asking, when is finance going to take that rebound? Because finance has taken a beating from COVID and they have not recovered. Financial stocks have not recovered.
Yeah, because as I was saying, the capital, they didn't prepare and they're paying for it. NCB did not prepare. Scotia did. And now you see why Scotia is number one and NCB is number two. That's an oversimplification, but it's a fact. Scotia prepared because during the pandemic, they weren't making as much profit as the others. Other institutions were making more profit. And everybody was like, oh, NCB. I'm like, guys, watch your capital because that's going to rule out in the end. And that's what happened.
Yeah.
That's what happened. Don't be surprised. Let's say hypothetically, don't be surprised if NCB continues shedding assets and Scotia pick up some of them. And if they don't, another institution might pick it up.
Sagicor will. I see it.
Yeah, because the thing with Scotia is, okay, they're big and they have the capital and all that. But again, they have a different risk culture. Their risk adjudication comes from Canada. So a lot of those capital allocation decisions are not made by Jamaicans. They have a totally different appetite and appreciation for what happens in the Caribbean. So what we might see as straightforward, they're just like, not really. Do we really need to do that? Do we really need that to grow? No. They mentioned that, Doje mentioned that non-performing loans are going to double from their pre-COVID level. What businesses are positioned for that? Not many. So again, it's a capital discussion. It's not a P&L discussion.
You mentioned something about the bull market, right? And you were saying that you think that there will be a day where the Jamaican market has a bull market. What do you think would be what would be some of the things that you think would cause that? Like if I'm an investor and I'm trying to position ahead of the bull market so that I am in companies when a lot of people then want those companies, I can sell to them. What do you think would trigger that?
All right. 3 things drive a bull market in my experience. Firstly, participation of new investors slash new money. So if there's a paradigm shift around that, and you have a lot of persons who are coming in who weren't invested before, then that is one condition. Another, and the most important, is actually liquidity. So when you have the benchmark interest rate from the central bank, BOJ, falling, what it means is that institutional investors will have to move their money away from money market instruments, stop rolling their money in the CDs, and put some more on stocks. Because again, they have to balance risk and return. So when those yields drop, they're going to have to find yield elsewhere. So they have to gain more stocks that have dividends so they can pick up more yield, what they call yield pickup in asset management. As stock yields become more attractive, they're going to buy more stocks. That's going to push up the prices. Retail investors are going to respond to that because one, they'll be able to get volume from these big buyers, and two, there's upward movement, which pushes sentiment. So there's a whole momentum aspect of it. So the retail investors, so it's BOJ first, then the institutional investors, then retail, then the rest of the latecomers will drive that. Then the last piece is the earnings environment. So right now we're going to be in a snag in terms of earnings overall, because again, we're going to have transition period, a lot of assets moving around. It's kind of an awkward situation. There's a lot of uncertainty. Not a great time for earnings, but you can pick early winners based on their capital, and you have to watch capital. This is a balance sheet and cash flow situation. It's not a P&L situation. But most investors watch P&L. A lot of people just look at the PE and look at the EPS and say, hey, yay or nay, just based off of that. So how can you take it a step further? By being strategic now and getting ahead of that. So once those conditions align, lower interest rates, institutional investors coming in, there's new money, and there's an improvement in earnings, then you will definitely have a bull market. And I think the next bull market is going to be bigger than the next, because our generation has a greater level of equity participation than the ones before. We have a different attitude towards stocks. We see stocks as more of a necessity than they did. They are just like, stocks are nice to have. We don't look at stocks as a nice to have. We're like, yo, if you're not buying stocks, you're signing up to play the game on hard. That's how we look on it. No, I would never make the case to say, and this might be for a new listener coming on, and they might have heard, hey, real estate is it. And I don't want that statement to sound like I'm telling you that stocks are better than real estate. I think everyone, as a matter of fact, should take a portfolio approach, not just in terms of one asset class, but multiple asset classes. So how can my stocks help me to reach my real estate goals? And how can I monetize my real estate to build my stock portfolio? It's working them together, as opposed to saying real estate is the best asset class because blah, blah, blah. And then stocks are better because stocks can generate this amount in a year and property can't do that. It's about getting them to work together because they each have unique benefits and they're supposed to be used as one benefiting the other so we can reach our overall financial goals.
Okay.
Yeah.
So it's those
Well
three
said.
things really: bringing in more new investors,
Yeah.
rates being cut, and then companies actually performing well in that environment.
Yeah. Better earnings performance. Again, the most important thing is capital, because what happens in terms of P&L is as a result of what you did before in terms of your capital. Because, for instance, Wisynco, holding large cash balances for many years, they were able to now expand their factory so they could sell more, drive more volume, and the P&L will show that. What the P&L is just showing what you did in terms of capital in the previous year or years. So again, persons who watch P&L alone are always behind the eight ball because they don't understand what's under the P&L. What's under the P&L is the balance sheet. A whole balance sheet is being managed. Who is holding these large cash balances? Who is borrowing because they want to and not because they have to? They're not borrowing to survive.
Yeah.
Right? That's the type of stuff you need to watch from companies. Is this company borrowing because they have to? Or are they borrowing because they want it? Because the debt is cheap and they can just pay it back. And they can just have their cake and eat it. Keep the large cash balance, borrow the cash externally for a low interest rate, pay them back, and don't touch the cash internally. Because once you spend that cash, it's gone, you know. But you can keep that cash, make it earn some interest, and then take deep, cheap debt and pay it off. And the money that you never touch is earning that much more interest because you didn't spend it.
Yeah.
So that's
That's
what you
actually
talk.
why Wisynco started to touch their cash balances, because they just, I think at the time they couldn't borrow the money, or it was more difficult, and they're like, you know what, we need this, we need to upgrade the factory same way. Let's just take a dipping in the savings,
Yeah,
you know.
same
So
thing
as you
for
say,
Fontana.
because they
Same
want
thing.
to, not because they have to. Yeah,
Yeah,
same thing for Fontana too.
yeah. And
Mm-hmm.
you have to watch those things very carefully.
Mm-hmm.
What companies are struggling with debt? Like
Yeah.
their man was running out of money. Their debt was
Yeah.
just consuming their
Mm-hmm.
operating cash flow. You have to watch those kind of things. So again, PNL is just showing
Even
you.
new listings are struggling with that, and you can see that. Some
Yeah,
don't even list,
I'm not. Hey man,
you know.
I've been very intentional in not talking about that.
Fair.
Yeah, even though
That's
I'm
okay.
Doctor Doom. Yeah, even though I'm
Yeah.
Doctor Doom, because
There are limits.
no, not really. It's because certain things can be misconstrued.
Yeah.
Certain things can be misconstrued. What I'll say though, in a general sense, so I won't talk about a specific company or whatever. When you're evaluating an investment company that's raising money, you
Mm-hmm.
need to look for a few things. You need to look for the company's pipeline. You need to look
The
for the
plans.
company's exits. What have they
Mm-hmm.
executed an exit so far? Because remember,
Mm-hmm.
the bulk of your return, especially in PE and real estate and certain asset classes, depends on the strategy you have. But let's use PE as an example. The
Private
bulk,
equity.
yeah, private equity in this instance now. Bulk of your return is from the exit. So what is the
Mm-hmm.
exit history? How have your exits panned out? Were they
Mm-hmm.
successful?
Have
Did
they
they
had any
generate the
exits?
return correct? Did they generate the return that you need, etc.? And then you need to balance the discussion around pipeline, what is to come, exits, what has gone already, and what you're doing now to add value.
Mm-hmm.
Are you a passive investor? So do you just allow management to do their job? Or are you one of the co-managers of the assets in your portfolio? And then lastly, you need to watch the management fee to see if you're in
Mm-hmm.
line with peers. Are you charging more
Mm-hmm.
money? Are you more expensive? Are you on assets or are you on book value? Stuff like that. So whenever you're evaluating any
Mm-hmm.
fund, as a matter of fact, any fund,
Mm-hmm.
you
Mm-hmm.
need to look at those things. And if
Yeah.
you're missing
Mm-hmm.
those things, gonna have issues. You're
If you
gonna have
come at a
issues.
way cheaper price. If
You're
give me a
gonna have
wicked
issues.
discount.
You're
It's
gonna
a
you're gonna
20
have issues.
cents.
Personally, I would not touch an investment vehicle that doesn't
Mm-hmm.
speak to exits and doesn't speak to a pipeline. I
Mm-hmm.
mean, I can see stuff around strategy and sector
Mm-hmm.
and fees, but those
Mm-hmm.
are the two main channels
Mm-hmm.
that
Yeah.
investors are interested in because that's
Mm-hmm.
how I can gauge how much risk I'm taking.
Do
Exactly.
you also think it's
And
the
then,
price you get it at though? Because like you would be willing to do something like that. It's just for that you have to give me a wicked discount that justifies or kind of bakes that
You
in
mean
a
to
way.
address just the transparency?
Yeah. Well, no, just saying like for example, like okay, there's a company where say they haven't exited an investment yet.
Mm-hmm.
Say the management fees are kind of high, but it's like
Mm-hmm.
almost the price that they're giving you at kind of
Mm-hmm.
justifies that risk, I guess.
Mm-hmm.
So that they're giving a very heavy discount on something like that to the point where it's like, okay, yeah, it's not the best, but it's like, okay, just giving me that cheap.
I was being generous, so I'll add something else. Let us say this is your third fund, right? You're on your third fund and you don't have any exits and you don't show me a pipeline and you come into the market. That's one thing. It's your third fund. You can be a first time fund manager with no exits and you're not showing me a pipeline. I don't care what price you come with. I'm not doing that. That's me.
yeah.
I am not doing that.
Mm-hmm.
Now, I do agree philosophically that there should be a discount, but how do you value that? You've never done a discount. This is your first fund. I don't see no pipeline. I mean, what do I have to work with? I don't have anything to work with.
Mm-hmm.
I don't have anything
I
to work
agree.
with, you know?
Yeah. And then
So,
just the whole thing around transparency too, because you also want to show what have you done even recently, like in the past year, and as an investor, if I'm going to buy into this, whatever investments it is, whatever company, it doesn't even have to be PE or anything, but I want to see some recent stuff, like what have you done this year. This is 2025 now. Tell me about the
These are
year. How did the
recent
year go?
financials, you mean?
Recent financials, tell me how the year went. The financials you're putting forward can't be from 2024. That's old. We're almost in 2026 now. You get me? So show me something of this year, even if it's the first 2 months, or first 6 months, sorry, of the year. right? Like from January to June, show me something. But
But just to balance the discussion though, because again, remember, I'm a villain, so you have a lot of persons who will misconstrue stuff. I speak, I speak directly. I speak directly. Like even though we're having a broad discussion, I speak
yeah.
directly about a company like Equity.
Mm-hmm.
The equity is needed. You need companies that are set up to take risk in small and medium sized enterprise in the Caribbean. It's a big problem. They're needed. And not just that, but when you have situations where these vehicles will come to market and don't get to raise the money, you create negative precedents. So the next time this happens, they'll point to it and be like, well, this didn't work out, so blah, 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 whatever. So now the next person who comes with an investment holding company in the Caribbean doing a PE strategy, even if it's different sectors, they have the pipeline, they have the exits, they have all these different things, bells and whistles. It still have negative precedents. Well, that never worked, blah, 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 whatever.
So they have to come with something good.
Yeah. The discount will likely be bigger. They're really going to have to pull the rabbit out of the hat. But
I've
just to
been
be
using that
clear,
phrase a lot.
it's needed. Yeah, it's needed though. It's needed. Equity is needed, and I want to see what equity comes with in the future. So
Yeah,
I don't
because
want.
I know Mears is gonna come back again, and
Yeah, for
it have to
sure.
be a sweeter deal.
Yeah, I know Mears. I know him. He's not my friend to say, boy, we par and drink rum, but he's a guy I know. And we see each other, we talk and whatever. And I just don't want our discussion to be misconstrued.
Yeah.
We want Mears to succeed. I think he's going to succeed. And I know how he is. He takes these things very hard. So just going, I don't know, probably just double the size of equity and come back.
Yeah,
So
that
let's
is
see.
it. We're looking forward
I'm
to it.
back.
Yeah.
Yeah, man, I rate that. We will see. We will see. And it's not gonna be the
Yeah.
last of him and equity at all. Because even some of the I think they own what's that medical company they own? Is it
Royal
Royal?
Medical.
Royal. Yeah.
Royal Medical too. I'm curious to see what they do with Royal as well. And just do they have a proclivity for like do they like health companies?
They are
Are they
healthcare
in that
bullish.
sector
I
really?
know they are.
Is them an MD link?
Yeah.
They also own piece of MD Link. So like what synergies are there? Are they doubling down in healthcare too? What else are they gonna come with? I'm curious to see. I love investments in healthcare. Like I like companies that take an interest in healthcare because it takes a special kind of company to do that. Because it's not the easiest industry to invest in, right? Returns aren't usually like this, it's not like a quick return thing. It's more of a longer term strategy. Some can be quick, yes, but majority of the healthcare companies aren't. It's not super sexy like dollar, right? It's not gonna make you a millions overnight, right? But the impact is real. The impact is definitely real. So
Yeah, it's
I,
also
I
very lucrative. And healthcare economics it's not widely understood because health economics or the drivers of health returns in terms of investment are very segmented and unique. So if you have like a medical facility, you have to know what offerings of the medical facility drive the greatest return on investment while still being able to balance your offerings so that you can operate. Pun intended.
So
So
you're saying like CT scans versus MRI versus X-rays. Like yes, you want to be
ultrasound.
able to offer all of them,
surgery,
but there's certain ones that bring in more of the money or more of the profits.
right? And you need to know how long your patient stay, your average patient stay should be based on the type of patients you see. So if you know your average patient stay, you're supposed to be 2 days, but your average patient stay on the ward is 4 days. You know there's a drag because you have to deploy more in terms of utilities and care and talent to looking after those patients where those resources can be oriented to more surgeries, more operations, more scans, more work around the lab and getting more lab output. So again, not being in health, it can be very difficult to see this because persons just be like, why?
Yeah.
Healthcare normally it's expensive, you don't understand that, blah, blah, blah. Yeah, it's not for everybody, but I am a healthcare bull, and it's good to see another entity bullish on healthcare, definitely. You need
Really
that.
good to
That's why you
see.
build an ecosystem.
Facts.
Yeah.
I think
Yeah.
the micro markets could do well for them or some of their companies.
You mean
Because
equity
maybe,
or health? You
Equity.
yeah,
mean?
yeah, but equity, like I was saying, like something like was it, what do you call it? MD Link. It's pretty
Mm-hmm.
small. When I looked at the equity prospectus, they showed, I think, some of the revenues and stuff is a very small company, it seems. So maybe something like that could help them, and I would give them their history of exits, so
Yeah, it
that the
would
next
give
time
them
they
some
come around.
reprieve. Yeah. And also even pipeline too, because you may not discover something from your deals desk, but you may discover something from micro market. It comes in
Yeah.
micro market and you're like, oh, they need like an additional 70 million in equity.
Mm-hmm.
Let me inject that and take them to junior market as an associate company. So who knows, a micro market may be a channel for pipeline growth for entities like equity.
Yeah, that's where you start out, and you can, if that's your exit, you take that capital,
Mm-hmm.
you fund another acquisition, and then rinse and repeat.
Yeah.
Yeah.
So you could do a micro market acquisition and turn that same asset into a junior market exit. And
Yeah.
that's how you build the ecosystem. That's
Mm-hmm.
how you generate the return. So yeah, really exciting time. That's the point I'm making. And I think
Yeah.
micro market happening while Jamaica is in this rebuilding phase is quite opportune. It's good. A lot of companies will need capital and they don't have the collateral, they can't borrow it. But now they have this new
Mm-hmm.
channel. I know investors are averse to giving up equity, but it's available. It's now possible.
Mm-hmm.
You now have a choice before you didn't. So
Exactly.
yeah, I'm looking forward to that.
And that would satisfy one of the three things you're talking about in terms of getting, I think, new investors and stuff. Because one of the interesting parts, if you look at it, the micro market is so small. Look at a listing, WIPT, West Indies Petroleum Terminal. I don't know if you saw so far how much has, like, so I think it listed at 50 cents. So if you saw like the amount, I think I had a video, I recorded it, like the buy queue. There were days where there's legit millions and millions of dollars buy queue, people who wanted to buy it at the 50 cents and no one was selling, and then it didn't trade until I think it started trading at maybe 70 cents, but it was like 5K units. And there's still a lot of demand. So it's like the same supply of like, or the same concept of high demand, low supply. But the micro market, some of these companies, I don't remember how much it was they said, but the company could technically say, hey, we want to raise 10 million, 50 million. Well, how much is it? Is it minimum 50 million or something like that?
No.
So it says
Maximum.
it's
Yeah, it's
10 million.
maximum.
Maximum 50.
But say the company wants to raise 20 million. 20 million, that's a very small amount. If you have say the investment bank, Victoria Mutual, Mayberry, whatever, GK, say, hey, we want a piece of that to make it nice for us, then how much does that leave the public with?
Actually,
It's going to be very,
person, I would argue the other way. I don't think the micro market was set up for those institutions. I think the micro market functionally may end up working out better for specialized vehicles like the Equity and Novamed because one, the capital is a bit patient, and two, they invest differently. When you have institutional funds, you're under more pressure. You kind of have to be more short-term oriented. You have to report quarter to quarter. You have to compare your return to the other guys that have the same assets. You kind of boxed in terms of what you can look at. And then the asset limits around related to the Pension Funds Act, it tells you you can only allocate a certain amount to certain asset classes. So you're really narrow. So I think that retail investors are going to drive the micro market. And I think specialized investors, like the companies I mentioned before, Novamed and Equity, are likely to drive micro market activity. I don't think the brokers, in terms of their unit trust, for example, or even their own prop book, is going to have appetite for that. It's going to be like, no. They
Yeah,
can't even
smaller
get
players.
approval. They can't get approval for that stuff. They can't because the same resources you're taking to evaluate those investment opportunities, you could be evaluating opportunities that give 10 times the return because of its size, not the percentage,
Some
but
of
the
them
size.
probably don't even like junior market stocks. I've heard like
No,
they
I
only
mean,
look on
I've been
main
in those
market.
meetings. It's a quarrel. I remember doing the analysis for a lab and pitching lab, and the chairman of the investment committee was so upset. He was like, this is a waste of time. What are you talking about? Why are we evaluating this? Why are we showing people this? Are you
Yeah.
crazy? I mean, I had a buy recommendation on it, but he was like, okay, if it's going to be a buy, put that is high risk because of the size and blah, blah, blah. It was a big thing. It was hard to
Wow.
get
Iris
that approved.
because of the size.
Yes, because he's saying that smaller companies can't compete as easily and blah blah blah. Remember the life cycle perspective of
Mm-hmm.
size now. Smaller
Yeah.
firms are more likely to be acquired or
Mm-hmm.
outcompete by larger entities and blah
Mm-hmm.
blah blah.
Let me guess, you
But
tried
there's
to
an
buy
obvious bias.
NCB.
There's an obvious bias.
Mm-hmm.
Well, at the time, NCB was over 200. This is 2019, so not really.
Mm-hmm.
Okay, okay,
Again,
okay.
I had my reasons for saying it was a buy at the time, but I'm just
Mm-hmm.
telling you that your comment about that is very real.
Yeah.
When you bring that to our investment committee, I'm telling you, man. I'm telling you, there's definitely a size orientation.
Mm-hmm.
And they're not going to
Yeah.
change them investment policy to allow for that. It's going to be like, no, next.
Unfortunate, but
Yeah.
yeah. Yeah. But
Yeah,
more
just the
opportunities
nature of the
for us
game.
as retail investors.
Yeah, and you now forget about retail. You can do your own private equity. You
Yeah.
invest in your own opportunities and you can now structure them yourself and have an
Mm-hmm.
exit. So you, Dr. Sims, you, Dr. Preston, you can now structure a deal and have an exit and you can do that. That's now a channel of wealth creation you did not have before. You may not have been able to go on that junior market run like some of the players did in the past. You can go on the micro market run. That's an
Real.
avenue that you have. Yeah. So forget about trading the stock. You can trade the stock fine, but you can buy the securities, do the sweat equity, work out the deal, have your earnout structure, or you can do a convertible note and upon exit and micro market, those converted common shares, and that's a liquidity event for you. And you
Mm-hmm.
do 4, 5, 6 of that, your standard of living is going to be different. So I just gave you guys some free game. I'm sure your guests don't do that.
No, not regularly. That's
Yeah.
rare. That's
Yeah,
pretty
because they
rare.
mean they're haters. They say I'm a hater, but I'm not, but it is what it is.
Yeah, you just Doctor Doom.
Yeah.
Who's the last person that gave us? Oh my gosh. But Julian, last final question, right?
Yeah.
And this is a question we ask every guest, of course. And I feel like we've asked you as well. But outlooks change based on the times and so on. And I wanted to know, based on the JFC, and if you had a more positive outlook on certain stocks, right? Is there a stock or two that you are looking at? Not saying you will buy. Not, of course, we're not asking for financial advice because we never give that on this show, right? You have to speak to your own licensed financial advisor. But is there a stock that you, for some reason or the other, that you actually have been looking on yourself, or it's something that you like, or a stock that you admire? What is it and why?
Okay. I gave away quite a few during the course of the discussion,
Mm-hmm.
but I would say right now, Fontana, definitely, because of what is to come. I don't think the full effect of Portmore has been integrated in terms of the earnings as yet, because Portmore has not reached its full capacity in terms of footfall. So there are many persons who are still discovering the Portmore location. So it's not showing its full potential yet. Obviously, the Monarch acquisition and the economies of scale that the company will benefit from as a result, the strength of the balance sheet, high cash balances, experience and management, all those things, put them together as a really strong case. I would say Eppley. I want to see what Eppley comes with because Eppley thrives in these kinds of conditions. They're very opportunistic. They're very contrarian. Right now, capital is expensive and markets are tight. The economy is going through a transition. The assets will move around. Eppley thrives on that kind of ecosystem. So I expect them to do a lot more deals. We spoke about M&A. I expect Eppley to come in and do some deals as well, both in real
Yeah.
estate and in other asset classes. So I would give it to those two.
Okay. I think Eppley's one people don't speak about as much. Yet they pay some of the highest dividends on our market.
Yeah, they're a cash
So
machine, man. It's one
yeah,
of my
man.
favorite
The
companies.
same. Very
Yeah.
small company, very massive portfolio.
Yeah. I
For
was
the
about to say small management, big balance sheet, and that's how you want to do
yeah,
it.
that's how you want to do it indeed. All right, Dr. Doom, thank you so much for coming on the podcast. Guys, if you love this episode, drop a like, hit that subscribe button, right? Show some love to Julian. Thank you so
Oh, I
much,
have a
man, for
bonus, by
coming.
the way. I have a bonus, not a
Oh, we love
stock,
that.
but I'm going to be releasing a newsletter
Yeah.
next year. It's affiliated with Wealth Watch, but it won't be called
Mm-hmm.
Wealth Watch. It will have its own sub brand. The sub brand is called Market Failure. I have not,
Mm.
I haven't revealed this anywhere else. This is the first time I'm talking about Market Failure or calling it by name. So you're getting a Limitless exclusive. It will be released
Exclusive.
primarily on LinkedIn because LinkedIn is a space for readers. I'll do a few threads on Twitter, but the bread and butter is LinkedIn. So stay tuned for Market Failure in 2026. We have the facts, we have the controversial position, but always oriented to making money. So look out for that. Market Failure
Okay.
2026.
We'll definitely look out for that. Market
Yeah,
failure.
yeah,
Yo, sounds like hot bread. It's gonna sell
yeah,
like hot bread.
yeah,
That
yeah,
is it.
yeah.
All right.
Okay,
You
nice.
guys heard it here first. Limitless podcast, right? So we'll probably check out one of the blog posts. It's a blog, right?
Yeah, it's a
You said
newsletter. So
a newsletter. Perfect.
so articles, hard hitting articles, just talking about the facts and the figures and what's the story behind the data and how to make money. So that's what it is. And it's
This is
not a
like a
departure from
global.
Wealth Watch. It is global, definitely. The same way we had a discussion that was very top down, economics
Mm-hmm.
driven, looking broad, and then we get specific and the why and all of that kind of stuff. That's the same type of format. So it would be like the word version of all kind of discussion.
Okay, awesome.
Okay. Yeah. Looking forward to it,
So it's a
Julian.
sub
We'll
brand
be
under
watching
Wealth
out for
Watch.
it.
It's a Wealth Watch
Mhm.
product. Yeah, man. Looking forward to it
All
too.
right. That is it.
Yeah.
Yeah,
Well,
drop a
guys, you
like.
heard
We
it
should
here
have
first.
him back on to talk about one of the maybe like a quarter one or something review of one of these blog posts.
Yeah,
Yeah.
definitely. You will.
All right. That is it, guys. Well, thank you again, Julian, as always, for giving us your time. We
Anytime,
appreciate
man.
it.
Thanks for having me, man. It's been amazing. And
Respect.
hopefully, we'll have more episodes in the future.
Definitely. That is it. All right, guys. Limit breakers, please stay limitless.
Peace.